Hello, everyone. This is Dave Keller with Market Misbehavior. I love asking interviewees what their one chart is. And what that means is if you had only one chart besides the S&P 500 as a way to understand the market environment and anticipate what's coming next, what would it be and why? And today I want to share with you my one chart, which is the chart of the XLF, the Financial Sector ETF. When you look at the XLF over the last 2 years, you can see this broad basing pattern, right? This low from the end of December of 2018, surrounded by a series of higher lows earlier in 2018, but then also to the right in 2019, a number of times we had these sort of short-term pullbacks. And so it appears to be what we'd call an inverse complex head and shoulders pattern, which just means a low surrounded by a series of higher lows on both sides. Now, what's interesting about this pattern is if you look at the neckline, which is around the 28.25 level on the XLF, you can see we finally broke above that in October of 2019. We broke to above 29, which was pretty impressive. We pulled back to test that 29 level in December of 2019, and then broke on to new highs. And at this point, most recently, the XLF has been trending higher highs and higher lows above two upward sloping moving averages, the 50 and the 200 day. An interesting thing happened though in the end of last year, beginning of this year. So if you look at December into January, you can see that the uptrend stalled a bit. So it rallied into mid-December and then just sort of hit this plateau range of, not really pushing to higher highs, not really moving to lower lows, or sort of hit an equilibrium. And for chart speak, when you hit an equilibrium, that essentially means we've decided on a proper price, right? Everyone as a market, collective market participants have decided that it's worth about $30.75 a share for the XLF. Then if you look at the second half of January, it broke below the 50-day, which a lot of times is a little bit of a warning sign that things aren't as strong as they seem. And if you look over the 4 months before, or 4 weeks before that, you can see that the relative strength started to turn lower. So while things like the XLK technology were sort of moving on to new highs, the broad S&P moving to new highs, the XLF was stagnant. And that's what causes this little bout of underperformance. I think right now is a really key time for the XLF because one of two things happen. Either it rallies along with everything else, and going into today's session on Thursday afternoon, you can see that it had rallied very, very nicely, testing a new closing high, not quite getting there, but really, really close. Felt like it's participating. Today we get a bit of a retracement, a little bit of a pullback, a little bit of profit taking. So one of two things happens. Either it's able to push through above resistance, push above 31.50, suggesting enough buying pressure to push this push the sector much higher, participate in the overall market uptrend, or it fails around these levels, gets back below the 50-day, back below 30, and starts to go down in this range, and either backs and fills in this range, or starts to break to new lows. And a break below 29, for example, would be a fairly significant breakdown. That would break below the low from early December. Even a break below 29.75, which would be the low from January, would certainly suggest a lower low and potentially break this pattern of higher highs and higher lows that has continued up through this point. So the XLF, the financial sector, is an interesting one because the market can rally without financials, but I would feel much better as a bullish investor if the XLF at financials were participating. So if this sort of thinking about investment process, decision-making, and visualization is of interest to you, I hope you'll hit subscribe on my YouTube channel. Check out some of my other videos on the Market Misbehavior Network. Thanks so much.